Welcome to the SUERF-EBF conference on banks' funding and revenue prospects in the low for long era. We have a rich program today to analyze first what low for long implies for banks, both on the revenue side and on the expenditure side. Second, to what extent COVID-19 has made the environment for banks even more challenging. And third, what strategies banks might want to adopt in the years to come post-COVID-19. To set the scene, let me share 4 pictures with you. What you see here is a thing that every one of you knows. It's the yield curve for German government bonds. The message here is that the yield curve within a year has dramatically shifted further down. It has further flattened and moved further into negative territory due to COVID-19. Now, all of the experts here in this conference are aware of implied forward rates. This is what I show you here for money market rates. The message here is quite simple. Money market rates are expected to rise only 5 years from now, and they are expected by markets to remain negative for almost a decade. The third picture shows you market expectations for German 10-year government bond yields. Again, you see that market expectations for 10-year yields have shifted down sharply within a year. And the current situation of market expectations is that German 10-year government bond yields are expected to remain negative for another decade, roughly speaking. Finally, if we combine these indicators and draw a somewhat simplified yield curve consisting of the difference between the 10-year and the money market rate, and then look at what market expectations imply over the next 10 years for this simplified yield curve, for the yield gap, then we see that markets as of early December of this year expect a pretty flat yield curve for the next 10 years. With this macroeconomic perspective, I would like to hand over to Gonzalo.
Thank you, Ernest, and welcome everyone to this first joint conference between SUERF and the European Banking Federation. When we conceived the idea of a joint conference last year, it was at the end of the SUERF conference on bank consolidation at the National Bank of Belgium. And it was a different world. We projected that the main topics to be discussed could be about illiquidity or the cost of funding. However, the reality has shown us that we have other problems to contend with after a very eventful year. I would like to set the scene with 3 flashes before I give the floor to the keynote speakers from the industry and the European Central Bank. If I can share with you a slide that summarizes the effect of policy response, including monetary policy, supervisory flexibility, the regulatory fix and recovery funds, it is the combination of all measures and the bank's commitment that has taken us to the end of the year with no major disruption to the banking system in its role of servicing the economy. The initial volatility was quelled, and confidence in the euro system was restored, reducing the perception of fragmentation risk to the pre-COVID levels. As Ernest showed in his projection, the conundrum now is not so much about the spread, but about the level of the yield curve in the next 10 years. On the regulatory side, a series of adjustments bundled in a quick fix have counterbalanced the pro-cyclicality inherent to the system, alleviating the effect of the crisis on core equity tier 1 capital ratios in almost 200 basis points. About half of this reduction will be permanent. However, other measures were just temporary or are up to the discretion of member states. In the next slide, we can visualize how the strong capital ratios of the European banking system have reassured its capacity to withstand the shock, in part thanks to a sizable voluntary buffer that banks are reluctant to dispense with. At this point, let me recall that the cornerstone of the Basel Agreement was laid a long time ago in a meeting in Madrid in 2003, whereby unexpected losses are covered with capital. Therefore, the distance between the actual level of capital and the minimum requirement, where penalties are imposed, represents the creditworthiness of every bank and the link between the prudential framework and the assessment of the market. Against this background, it is no surprise that it seems a hard decision to take for a bank to reduce the buffers, at least in a market-driven environment. On the right side, if we look at the market of CoCos, the volatility experienced in March was soon reduced to normal levels. In a last slide, we summarize what was the ultimate objective of the policy response was to keep up the level of lending, and it has been largely accomplished so far with an increase in the use of credit lines by non-financial corporations while maintaining the amount of credit to households. However, a long-standing issue in the banking industry remains unresolved. A recent study published by the Bank of Spain indicates, interestingly, for the first time in years, a drop in the estimated cost of equity. However, the return on capital is also depressed, widening the reversal gap again. Whether this trend is incidental or structural is a fundamental question that will be subject of discussion today. In conclusion, as we turn the page of the great financial crisis, new and bigger challenges lie ahead. Banks turn out to be part of the solution, and as such, we need to understand in depth the new habitat for European banks, which will be conditioned by the consequences of COVID-19 and the policy response that is still ongoing. That is the purpose of this session that will give us insights from different angles: supervision, regulation, academia, and banks. Do not forget that we are all on the same boat. Now I'll have the pleasure to introduce the next speaker, who will be the person who is at the helm of the banking boat in Europe, while it navigates through the most turbulent waters in decades. Pierre Mustier, President of the European Banking Federation and CEO of UniCredit Group, please, the floor is yours.
Thank you very much, Gonzalo. Good afternoon to everybody, and thank you for inviting me. I'm really grateful for the collaboration between our two institutions, the European Banking Federation as well as SUERF. I will be brief and raise only a few points before the different panel will start. First of all, during this time of unprecedented crisis, the reaction of the government and the authorities, the central bank, has been absolutely exceptional, and the coordination between the EU authorities for a combined action plan, including all the toolbox of the policies, both on the monetary side and on the regulatory side, and action from the different governments, is unprecedented and extremely effective. So we can see here that the combination of EU ECB liquidity, supervisory flexibility, regulatory fix, and availability of massive amount of public guarantees have been, the right answer to such a crisis. And as you mentioned, Gonzalo, banks are part of the solutions. On a natural reaction when we have a crisis for a bank is to tighten up their lending criteria. But thanks to the government action and specifically the government guarantees, the banks have been fully part of the transmission mechanism and are a critical part of making sure that we can fund our clients, specifically those most affected by the crisis. But we should not forget either that investors are part of the solution as well. While we can fully understand that the ECB asked the bank to refrain from paying a dividend until October 2020 and then extended this ban up to January 2021 because of the environment, because of government extended massive amount of government guarantee loans, mean, it is now very important that we give visibility to our investors about the capital return to investors from banks. And when we look at the overall dividend distribution in Europe for the first half of 2020, I mean, for banks, the payout has been only 14% of the amount of 2019 revenues, while for all industries worldwide, it was around 77% for the amount of 2019 revenue. So clearly, we have a big risk to make the banking sector uninvestable if we don't have a relaxation of the rules of capital return. And it's extremely important that there is a predictability of the dividend policy for investors in order to make sure that the European banking sector can keep attracting funding on one side and equity investment on the other, as here we compete with banks on a worldwide basis, and we don't want to have the banks put, European banks, put at a competitive disadvantage. So we need as well to have some predictability of the regulatory condition for a soft landing, as access to finance will be absolutely fundamental in the recovery phase, which for some of the sectors might be longer than for others. Arguably, in the past, there has been more forbearance or too much forbearance 10 or 15 years ago. Now we have much stricter regulation with the short calendar provision backstop, and so which give us or doesn't give time needed for restructuring many business that are still viable. So in the current environment, it is important that we maintain the credit supply to the client, which face difficulties. They can be supported now by the government guarantee loans, but some won't. And after the government guarantee loan expire, we need to make sure that the regulatory environment will allow us to extend credit to this client in the smoother basis, provided, of course, that medium term they are viable. Another impact, and that will be my almost last comment, is the negative rate for longer. It's clear that the negative rate policy was a good thing initially, as on one side it was penalizing the bank, not too good for the banker. On the other side, it was allowing the economy to be more resilient, so the banks had less provision. So on balance, the banks should have been benefiting from that. But if we have a negative rate policy for longer, or forever, if you look at the time horizon that bankers or investors have, it does impact very structurally the profitability of banks. And this profitability is impacted structurally because we have an asymmetry in bank balance sheets. The loans are priced on Euribor, which is negative, while the deposits, for a large part, are floored at zero. Plus, if you add the fact that the investment portfolio or the swap replicating portfolio today are done at rates which can be even negative, you can see that the profitability of banks, if we don't have a normalization of the policy at one stage, will be structurally impacted in Europe, which there again put us at a competitive disadvantage in order to attract capital. And if banks cannot attract capital, they will have more difficulties or will be less efficient in order to fund the economy. And this negative rate for longer can raise as well the point of the reversal rate. And that was a very good and a serious analysis done by Isabel Schnabel, which has been shared recently, and some team members of the ECB, about where is the reversal rate and would the behavior of some economic agents, the banks, for instance, be contrary to what the central bank could expect. So, we have to live with lower rates, we have to live with negative rates, but the negative rates can push for low price credits, and which will create a problem of sustainability of the bank profitability in the medium term. So I think it will be important as well to see what are the different means that can be applied in order to ease the negative impact on negative rates on bank. The extension of the TLTRO, which was announced yesterday, could be one of them. But I think more focus has to be put on the issue so that the banks can handle, the future, the uncertainty of the crisis, as well as additional regulatory burdens, which are already expected in terms of regulatory headwinds, completion of Basel III and others. So, let's keep that in mind. For Europe growth to continue, we need banks which are very profitable, otherwise it will not work. So I look forward for the discussion of all the participants to this event. And thank you very much again for being with us. And thank you to all of you and the EBF and SUERF for this seminar. Bye-bye.
Thank you very much for your insight, Jean-Pierre. We open now the floor for questions. The first question is about the dividend policy. We learned yesterday from the PRA that the dividend policy will be opened again. There could be a resumption of dividend payouts upon certain conditions and within certain limits, including up to 20 basis points of the risk-weighted assets. Does this give an indication of what should happen in the global market of banks, and how will this be taken by the investors in the banking system?
Well, I think that if a continental European bank under the ECB supervision are put at a competitive disadvantage. In other words, if US banks, a UK bank can return capital to shareholders and they cannot, that would be a problem, and the capital flows will not come to the European banks. So, as I said earlier, it is important that the level playing field allows us to attract capital from investors. If we don't have the right capital, our cost of funding will increase, our cost of capital will increase, and it will penalize the economy. So I'm hopeful that the move of the British Central Bank could be a good indication of what the European Central Bank can do. But I think beyond short-term actions to allow for a partial capital return, what will be important for investors is to have a long-term visibility of what can happen. And I'm hopeful that probably once we have a result of the EBA stress tests, which are going to be conducted on the end-of-year balance sheet, and this result should be publicized by June or July next year, then we can return to a fully normalized capital return policy for shareholders.
Second question, as we could expect, is about the potential upcoming wave of non-performing loans. How can the banking system assimilate the potential shock in terms of NPLs once the measures that have permitted the moratoria and state guarantees come to an end? Or what is your advice to deal with that increase of NPLs?
Well, the ECB has sent a Dear CEO letter very recently to all European banks to ask them to look at the impact of this crisis on their balance sheet and take proper actions in terms of monitoring of the credit and in terms of provisioning. It is not an easy topic, specifically for loans which are under moratoria and for companies which have been able to benefit from a government guarantee loan, as we have to simulate a medium term what could be the cash flow situation of these banks, or these clients, sorry. And what we're doing at UniCredit, I'm not speaking here as CBF, but UniCredit, is that we have segmented our portfolio from high impact to low impact. And the high impact portfolio specifically, we have looked subsector by subsectors as a cash flow simulation in order to define the stress and the default risk that we can see. And we apply this default risk for all the loans, whether they're under moratoria or not moratoria. And we take what we could call overlay provision in order to anticipate the specific cost of risk, which could happen once the moratoria is lifted, for instance. So I think it's important to have a proper monitoring and a proper anticipation of what could be the evolution of the credit in order to put the provision behind us and look forward, to 2021 with, a much higher profitability and net income, because all the pains would have been taken, or most of the pain would have been taken in 2020.